Hi there, welcome to the Open and happy Friday. Whoa, we've got lots going on in the market. We have seen a partial rebound in some of those tech names, but investors spooked about the massive spending plans at Amazon. Let's get to the big stories we're bringing you from our newsroom. Canada's economy lost nearly 25,000 jobs in January. Economists had been expecting a gain of 5,000. According to Statistics Canada, the manufacturing sector was hit the hardest, with U.S. tariffs continuing to weigh on industry. January's job loss marks the steepest decline since August of last year. Now, the unemployment rate did fall, hitting 6.5%, but that was mostly because fewer people were looking for work. And shares in Stellantis collapsing in the pre-market. The automaker says it's taking a write-down of more than $25 billion on its shift in electric vehicle strategy. And Stellantis is also selling its stake in a battery-making plant in Ontario to partner LG Energy Solution. That plant was set up in 2022. Under the terms, LG will now own the facility outright. Stellantis will continue to source battery products from the factory. Shares in Canopy Growth higher, up about 3% after the cannabis company posted net revenue and profit in its third quarter that topped estimates. Canopy says the results were led by strength in Canada, and profit was also boosted by cost reductions. U.S. futures pointing to stronger open on Wall Street right now. However, as of today, the U.S. market was down about 2% this week. Let's have a look now at the TSX, and it, of course, has slipped from its record highs. However, still up well over 26% in the past year when you include dividends. And let's check out oil today. And you can see it's down. The price has been supported this week by fears that those U.S.-Iranian talks are going nowhere. And let's have a look at gold. Among the most dramatic stories in the market this year, gold rallying slightly, but stuck below that $5,000 level. And finally, the Canadian dollar. And the Canadian dollar strong once again, comfortably above 73 cents US. And finally, Bitcoin. And there's drama there as well. Earlier, the price was threatening to drop below $60,000 for the $60,000 US for the first time since 2024. But you can see the original cryptocurrency has staged something of a recovery. Let's get back to those weak job numbers in Canada. 25,000 jobs lost in January. The unemployment rate dropped, but that was simply because people stopped looking for work. Let's get perspective from Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Earl, thank you very much indeed for joining us. What do you think was important in this jobs report?
Yeah, good morning. Good morning, Andy. You know what? I'll start with how the Bank Canada looks at it, and then we'll break it down into the important things. All else equal, this job, the headline job number down 25,000 says the chances of an ease increases this year. Having said that, when you break down the number, it's not as clear. And the reason why is that 25,000 was broken into two parts. Your part-time jobs were down, let's call it almost 70,000, but your full-time jobs were up 45,000. That's a split that the Bank of Canada will not mind. And by definition, the full-time jobs are people employed throughout the year. When part-time jobs include like seasonal jobs, Christmas sales workers and the like. So the split of 45,000 full-time jobs being created is very good. So that kind of offsets the headline. So let's call that neutral. The second thing the Bank of Canada will look at is the unemployment rate. That dropped to 6.5%. That actually decreases the chances of an ease because it says employment is getting better. There's less unemployed people. Having said that, when you look under the hood again, it's not as clear. The reason why it dropped was not because of increased job creation, but because less people looking for work, as you mentioned before. The question is, why are less people? So again, although 6.5% is increases or decreases the chances of easing, the under the hood says, okay, that's neutral. And the last thing the Bank of Canada will look at is, what is wage inflation? Wage inflation, again, came in much lower than expected, 3.3, I believe, versus 3.7%. The Bank of Canada will like that. They want to see lower inflation. That increases the chances of an ease. Having said that, we're still above the higher end of their range of 3%. So all in all, Bank of Canada on hold. They still have flexibility to ease later in the year. And that's what we just got to look at more data and look at the U.S. unemployment data next week.
Why would people have been dropping out of the labor force or stopping their search for work, Earl?
Yeah, there's a few reasons. One, it could be not disgruntled, but frustrated job seekers in regards to maybe they're looking for a manufacturing job, and you saw the numbers there. So just because they're not getting any leads, they might be frustrated and go on the sideline. Another reason might be education. Maybe people are going back to school. That would be a good reason, to retool the skill sets. So again, you got to look under the hood, see what the catalyst was. That's one of the things our team will be doing this week, just to see what the big driver of that is. That's where we have the biggest question.
What is your overall view, Earl? If you had to come down on a most likely case, how many cuts do you think the Bank of Canada will be forced into this year, if any?
We think one cut at most right now. We used to think up to two cuts, but again, the GST rebate is stimulative to the market. We're also very constructive on the U.S. market. An interesting fact, tax receipts in the U.S. for the month of January was a $60 billion surplus. That just speaks to the underlying strength of the U.S. And you know what? Despite the uncertainty, if the U.S. does well, we will do all right.
This massive drop in manufacturing jobs, or let's say a nasty decline, is that likely to be a 1 month phenomenon? I know that's a very hard prediction to make.
Yeah, no, it's not a hard picture to paint. It's going to be until Kuzma is settled, until those trade negotiations are settled. We will probably see we won't see growth in manufacturing job, and we'll probably see continued weakness. And the reason why is there's no medium or large size companies investing in manufacturing plants right now because they do not know the rules or economics of the investment. You will have a better sense of, what revenues could we expect in the next 3 to 5 years once you know what the agreement is between Canada and U.S. The reality is when a lot of larger companies come to Canada to create jobs or build manufacturing plants, they're not just thinking about Canada. They're definitely thinking about Canada, but they're also thinking about the U.S. and the possibility of exporting there. So until we get some clarity there, we expect to see, let's call it malaise in the manufacturing jobs. So that's not a surprise. We're not that number wasn't a surprise to us. It won't be a surprise to the Bank of Canada, but that's what we're waiting to see until we get settlement there.
So you think that Canadian 10-year bonds, for example, look like a reasonable buy right now?
Yeah, I think that's a good word that you use there, Andy, reasonable buy. And the reason why they look like a reasonable buy, we're very close to the higher end of the range of 2025. So it's good there. One thing we would prefer to buy in Canada, rather than just a 10-year government bond, is a 10-year corporate bond. And the reason why is you get an additional spread, let's call it 80 basis points higher than your 10-year government bond. And we're constructive of the U.S. economy, which means Canada should do all right. There's also a tailwind behind fiscal spending to keep the economy going in Canada. So we think that's a positive as well. So that's what we would prefer. We don't mind that 10-year 5 to 10-year sector, but we would prefer corporate bonds to government bonds.
And we're just looking here. You have a suggestion for us, a 30-year Brookfield renewable bond.
Yeah, and you know what? We don't venture into the 30-year too often just because there's so many unknowables, let's call it there. But this is one we have a high amount of confidence with. Like we said, it's about 130 basis points higher than the 30-year government bond, but 90% of the revenues here are fixed. And 70% are inflation linked. So it gives you a high degree of certainty of not only the coupon being paid for those 30 years, but the principal being paid. So this is what we look at when we do venture further than 5-10 years from a corporate bond investment. You have to have a solid balance sheet, and you have to have a solid and known outlook in regards to the revenue growth in the future. And that's a very attractive one in our portfolio.
30 years. I mean, that's for a conservative part of your portfolio, 5.1% yield for 30 years.
Yeah, conservative, but and it's the highest part of the yield curve as well by nature. The longer out you go, the higher yield you would get. It's also it's global. It's in renewables, non-carbon investments. So we like that theme as well as we go forward. So there's a number of good things behind this bond.
30 years. Gosh, I'll be getting close to retirement then. Earl, thank you very much indeed for joining us. Earl Davis, Head of Fixed Income and Money Markets at BMO Global Asset Management. Coming up, shares in OpenText came under pressure. There were mixed results in the company's latest quarter. That's ahead. At least one software company saw its shares, recovering slightly this week. Let's have a look at OpenText here. That's an Ontario-based information manager. The stock coming under pressure yesterday. It's big in cloud. That's where investors see growth. Let's find out what the latest earnings mean for investors. We're joined by Steve Enders, software research analyst at Citi. Steve, thanks very much indeed for joining us. Now, OpenText, I always think of them as a company that helps corporations manage the vast amounts of data coming at them, sometimes for regulatory purposes. There might be an email. Oh, that's important. Just update us. How do they make money?
Yeah, I think that's probably a good place to start. I think at the core of it, they're really good in information management, content management, managing all of your content, especially in a secure and governed way. I think the company has expanded over the past decade, really has been focused on M&A, and they went and acquired quite a bit of assets from things like Micro Focus and others that have kind of expanded beyond those kind of core roots and content. But I think when you look at it today, the core is still content, and then you have things around security and data analytics in their business network business, but it's all kind of centered around the sharing and the management of content at its core.
Stock is up a little bit in the pre-market, but we have seen a rally in some of these tech names that have been battered, but they include OpenText. Have they been caught up in this worry that tools from companies such as Anthropic will just erode their core business?
Yeah, I think that's very much the concern in the market. And I think, to your point, we are seeing that kind of broadly across software and at this time. And I think there still is some ongoing concerns around what the future of any of these companies is going to look like. Even in an area where you might feel like it might be a little bit more secure, either in the infrastructure layer, which I think is sort of what OpenText is trying to pitch right now, and how they're trying to frame things, is that they help enable the next wave of software and helping you manage agents and helping you kind of build those solutions moving forward. I think it's still early days for that and what they're doing with their Aviator solution, but it is still something that they're focused on, and I think they feel like they're well set up to potentially capture and execute on this agentic workforce that's coming in the future.
So the revenue was nearly flat year over year. Was that because of divestitures?
Yeah, so I think it's an area that's probably coming a little bit more in the future. I think they just closed their first major divestiture this quarter, and so that's not showing up until we start looking at fiscal 3Q numbers. But that did have a bit of an impact in terms of what they're guiding to at this point. I think for OpenText there is quite a bit of I guess there is some impact from prior divestitures that's hitting here as well. But then there is also just some volatility within the core business as well in terms of when revenue comes through and some of the more challenging comps that they have, especially on the licensing business, their on-prem portion. So it's kind of multifold. There is some timing dynamics, and that's also kind of impacting part of the fiscal 3Q guide. Here, where you do have some deals that kind of got pulled into their 2Q in the most recent quarter, and I think that's partially probably what's impacting the I guess some of the performance is just there's not a great line of sight to when some of these deals might hit, and it does create a little bit of volatility from a numbers perspective, especially when we start looking at the year-over-year growth rates.
And what would be their secret sauce? Is there something unique to OpenText's technology?
Yeah, I mean, they're really good at content management. I think both from the core business within OpenText and also some of the acquisitions they've made, like Documentum, that I think they acquired almost a decade ago. But I would say they have some of the best assets within content management, and it really comes down to everything around security and governance when you're dealing with that content. I think they have really good relationships with SAP and have a really good partnership there where they do really well within that ecosystem. And I think it really kind of helps enable a lot of what they do. And so I think when you think about where they're essentially kind of focused, it's everything around the content management layer, and then that extends into other use cases. Like in security and trying to manage that posture, and then also looking at kind of the business network side and managing supply chain and sharing of contracts. And so just a lot of use cases around content and a lot of things that you can kind of do with that data that could be helpful, beneficial in the future as we think about training AI and training agents for this next phase in software.
We're tight for time, but Bloomberg says that there's 10 holds out there and only 3 buys on the stock, and you're neutral right now. So what would you want to see before you went to a buy?
Yeah, I mean, I think a lot of it comes down to just having more confidence in the forward outlook and be able to feel comfortable around where estimates could go here. I think the big thing is just thinking through the divestitures that they're planning to make and what's going on, and feeling better around kind of what the free cash flow progression will look like, and just kind of getting a little bit more confidence through the uncertainty that's going on. And I think if we get a little bit better line of sight to those things and a little bit more consistent execution, then I think that would provide a little bit more confidence on top of managing through the current headwinds and concerns that are in the marketplace related to AI and the impact that could have on OpenText longer term.
Steve, thank you very much indeed for joining us. That is Steve Enders, a software research analyst at Citi. Coming up, his shares in Strategy moved up in the pre-market, but of course, this has become something of a poster child for Bitcoin concerns. It holds vast amounts of that crypto. TD says the company looks better positioned than ever to weather weakness in Bitcoin and benefit from a bounce back. We'll have more after this. Shares in Strategy have been moving up in the pre-market. Now, this is the world's biggest corporation that holds Bitcoin. It's called a Bitcoin treasury company. We are joined now by Lance Vitanza, Managing Director and Senior Research Analyst at TD Securities, who says volatility in Strategy, it's not a bug, it's a feature. And this stock is meant to rise and fall with Bitcoin. Thanks very much indeed for joining us. Lance, we're tight for time, and I'm so sorry, but the essential value of Strategy is the Bitcoin it holds.
Thank you for having me. Yes, the premise of Strategy and the brilliance of Strategy is that it has taken a highly volatile asset Bitcoin and created securities that have either amplified or tempered that volatility. So it's not just that it owns a lot of Bitcoin. You could buy an ETF and get exposure to Bitcoin, but with an ETF, you know, you're not going to be able to increase the amount of Bitcoin that you own per share, whereas with MicroStrategy over the past, several years, they've been able to increase their holdings of Bitcoin on a per share basis dramatically.
You probably saw that Michael Burry, the hedge fund manager, took a swing at Strategy, arguing that this company, if Bitcoin goes on weakening, could find, quote, capital markets essentially closed. And he said additional drops could push the Bitcoin miners towards bankruptcy. So is Burry overstating the threat here?
Well, I think there's some validity to that, but there's a lot of confusion around this point. We don't see any realistic scenario in which Strategy is forced to materially alter its game plan, let alone sell any of its Bitcoin.
Oh.
The company has fixed charges of about $900 million. Its first note maturity is a $1 billion convertible obligation that becomes puttable in September of 2027. It's a discrete put, but let's assume the worst, and let's assume that that's put back to the company in September of 27. Now, the software business does generate some cash, but let's be conservative and assume that dries up. The company has built a $2.25 billion cash stockpile. So without raising another nickel, the company can redeem the notes that are put in September 27 and pay interest and dividends for another 16 to 17 months. So a lot of people are focused on, well, what's the Bitcoin price at which the company's assets no longer exceed dividend, the value of its liabilities, and that price is about 23,000 per Bitcoin, by the way. But that misses the point. Bitcoin could fall to zero today, and the company could simply hunker down and wait for a potential recovery. They are funded into 2028, and that's before they raise another nickel. Now, last month, January of 2026, the company raised over $3 billion of public equity capital, common equity capital. They raised more than that if you include the preferred shares that they also sold. My point is that for a company that can raise $3.3 billion in a very challenging crypto environment, I don't think investors should be overly concerned about this company's ability to meet its what we consider very manageable and prudent financial obligations.
Right. So it's not going to default on its debt, in other words, in the foreseeable future anyway.
Well, not only in the foreseeable future, but it's hard to imagine that the company wouldn't be able to raise, they have a total of $8.2 billion of convertible debt that is puttable or matures starting in late 27, as I mentioned, and continuing into early 29. But let's consider the bulk of it as being a 2028 problem. Again, in order to solve that problem, the company, worst case scenario, they would have to go out and raise an additional $6 or $7 billion. Well, they raised, roughly half of that last month.
We'll have to.
So,
Lance, I'm so sorry to cut you off. Thank you very much. I didn't know a lot of that stuff about Strategy. You covered a load of ground there. Thank you very much indeed.
My pleasure.
Lance Vitanza, Managing Director and Senior Research Analyst at TD Securities. We got those opening bells next. And there we have it, the opening bell ceremonies on Wall Street and Bay Street. Over at the NASDAQ, it's Spyglass Pharma. At the NYSE, Once Upon a Farm is celebrating its IPO. And at the TSX, it's Hamilton ETFs. It's time for the first 50. And there is a look let's have a look at the big indices. And you can see the TSX Composite moving up and the S&P 500 and the NASDAQ. But still, it's been a choppy week, to put it euphemistically. The U.S. market down around 2%. We have seen, though, as I mentioned, a rally in some of the big U.S. tech names, including including the software names this morning, but loads of them down, well down over the past few months. Let's check out some stocks of interest here. OpenText, we just talked to Citi about that company. Citi sticking with a relatively cautious hold. Most analysts are at a hold on OpenText. Revenue flat in the latest period, but like other software stocks, seeing something of a bounce off the bottom today. Let's have a look at TMX Group, parent of the Toronto Stock Exchange. Its results beat expectations, 60 cents. About 6 cents earnings per share, about 6 cents above expectations. But that stock's been weakening as well. Now, we saw a drop in London Stock Exchange shares over the past week, partly because people worried about their big profits from selling data. And I see that the TSX has been hurting as well. In fact, that stock yesterday, or today, certainly yesterday, trading at its lowest in at least a year. We are going to hear from the CEO shortly. And let's have a look at Canopy Growth, that company beating expectations, but again, stock up, but shares down almost 60% in the past 12 months. Let's check out some movers south of the border. We are joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Thanks very much indeed for joining us, Jeff. Molina down, profit missed expectations, or the profit forecast did. And can you remind us what Molina does, please?
Molina is one of these healthcare companies, healthcare insurance companies in the United States. They've been under a lot of pressure, and this stock is under tremendous pressure this morning. In the pre-market session, it was down as much as 33%. Wow. So it is definitely one worth watching. It is the worst performing stock in the S&P 500 so far today. And this comes after the company already declined, the stock already declined 40% last year. So these healthcare stocks, as we've talked about in the past, have been under tremendous pressure. This morning, what happened, they came out with a profit view for 2026, which was half of what Wall Street had expected. Ooh. So well below Wall Street expectations for the guidance here. They also said that they're cutting one of their programs beginning in 2027. The issue primarily is that some of those Medicare Advantage, Medicare programs, which have seen rising costs in recent years in the United States, have continued to escalate in terms of cost to the company. And we are seeing some peer moves lower this morning as a result as well. Oscar Health and Centene, two other health insurance companies, really getting hit so far today as well, just because this profit forecast from Molina was so rough. As I said, half of what Wall Street had expected. Oh, and I should also mention, just to layer some bad news on top, guidance missed by a lot. They also had a surprise net loss. So Wall Street had expected a narrow profit of about 34 cents per share was the expectation for profit. The loss was $2.75 per share. So quite a bit below what the street expected, both in terms of the quarter and in terms of what's ahead. The stock's getting pummeled.
And Amazon, yet another company planning extraordinary spending on AI and other items this year. I think it's about $200 billion US.
It is $200 billion US, and that is what analysts on Wall Street are calling sticker shock this morning. If not for Molina, this would be the worst performing stock in the S&P 500. It was down 8% in the pre-market session. So it is also, 8.6% now in regular trading. It is also getting hit hard today. That $200 billion in AI spending, as you mentioned, that is well ahead of Wall Street expectations. At the high end, Wall Street expected about $150 billion in spending this year. So 200 is well above. And what we have here is a number of banks on Wall Street cutting their price targets on the stock. As a result, Morgan Stanley, JP Morgan, UBS, Wedbush, Oppenheimer, all out today with price target cuts on Amazon. And it's just worth reminding, this is kind of part of a bit of a trend that we've seen. We have seen a handful of these big mega cap tech names come out with AI spending plans that were well ahead of what the street kind of expected, while at the same time raising questions about whether or not those massive investments would be paid back. So just in the last week, among that kind of magnificent 7 group, we've seen Google, we've seen Microsoft, and now we've seen Amazon sell off as a result of those spending plans and as a result of questions about whether or not the investment will pay off.
Thanks very much, Jeff. Really appreciate it. Bloomberg's Jeff Morgan. Coming up, making sense of fluctuating markets. That's ahead. It's never easy for investors making heads or tails of the market, but it's pretty challenging right now. Our guest says he's still comfortable, generally speaking, with value stocks, especially small and mid-cap names, if they are involved with AI. He likes to look out for what he calls AI enablers. We're joined by Drew Pettit, U.S. equity strategist at Citi. Drew, always great to hear from you. Thanks very much. We'll get to some of your stock ideas shortly, but what do you mean by AI enablers?
So we think about AI from a value chain perspective. It's not just about creating, I would say, the large language models, but in the back end, what do we need in infrastructure? So the enablers are the front end of the supply chain. That could be anything from building physical infrastructure to chips in data centers to power. Again, it's not just the software and the stuff that we see and use every day.
What about the big names that we think of as AI plays? Alphabet and Meta, even Amazon, because of course the cloud is going to need so much AI capacity.
So we still like having some exposure. We think if you're going to play that end of the value chain, you stay up cap with the companies with a lot of cash. Again, we understand they're investing a lot, and investors are really trying to decide if they like that investment and if they'll get future returns. But if we're going to make a bet up there, we would rather be on those quality companies generating a lot of cash flow that can pivot and move as the circumstances changes. When we get back in the value chain, small and mid cap get more interesting because you're actually paying a lot less for those types of names. By no means are they expensive, but when you're looking at, let's say, 25% growth for 2026, I'd rather pay 20 to 25 times in PE than 30 times for some of the mega cap enablers.
So you have some ideas for us. Start off with SoFi Technologies, SOFI, on the NASDAQ. Just remind us what they do and what draws you to this name.
Yeah, so a little bit different trade and talking point here. We're thinking about fintech. Just for some color, when people were looking at the changing dynamics around, I would say, U.S. politics heading into the midterms, they were looking for, how can I trade the consumer getting juiced up? And they were talking about consumer stocks. We thought fintech actually had more leverage. And a name like SoFi, they basically deliver financial services to smaller consumers that might be underbanked in a way. They provide lending. They provide crypto investments. Again, broad set of financial services, more targeted to smaller consumers that might not get traditional banking love from the big guys.
You have another name, Affirm, and of course, they're well known for providing buy now, pay later credit.
Yeah, exactly. And same thing. Say you give the U.S. consumer an extra $100 that they didn't have before. Well, they might go out and want to spend $200, $300, or $400. So they need credit, and alternative credit is probably going to take share in the lending world. So Affirm and even another name like Klarna play to that in the buy now, pay later space.
Yeah, Klarna. Remind us what Klarna is all about, KLAR.
Yeah, same thing. Buy now, pay later, alternative credit to folks that may not be getting more and more credit from the big banks.
And certainly when I'm shopping online, I see pitches, hey, buy this on credit through Klarna. Block, another fintech name, more involved in payments, though.
Yeah, but it's funny, on the back end, outside of just the Cash app, which again, peer-to-peer transactions, moving away from the traditional financial system, they also do micro lending. And they also help small and medium-sized businesses with payment platforms as well. So again, if you're going to juice the lower K of the U.S. economy, these are the companies that are disruptive in their spaces that likely take share, But what you've noticed in a lot of these charts, when we're in a risk-off environment, these do not trade well. These are high beta, satellite-type names you can add to your portfolio when we start seeing risk-off and increased liquidity in markets.
Just leave us with a final thought, bro. I know this is a very hard call, but do you think that we are going to see this risk-off, people avoiding more volatile assets for quite a while?
I think it'll go in phases. So to really answer your question directly, no. And honestly, there's parts of risk and parts of volatile assets that really aren't doing bad. So you kind of let off the segment with, we really do like value, but within value, we like cyclicals. And if you look down cap, US small mid cap, the profitable names that are showing inflecting growth, that are showing better margins, they're still up 10, 12% this year. So those are cyclical risk on names. They're working. The growth risk and innovation risk, that's where most of the volatility is right now. I think we're going to rotate from one type of risk to another, but generally we still think we're in a bull market, but later stages, it's just going to be more volatile.
Drew, thank you very much indeed. Really appreciate it. Drew Pettit, U.S. equity strategist at Citi. Have a great weekend, Drew. Thanks again. Coming up, TMX Group beating on profit in its latest quarter. We're going to hear from the CEO. Of course, some of those exchange stocks have come under pressure amid fears of the potential impact of AI on their lucrative data and analytics businesses. We'll have more after the break. Okay, let's focus now on shares in TMX Group. Not so long ago, that stock was hitting record highs. As of August of last year, it was north of $57. It has come down a bit, trading right now at about $46. The company posted fourth quarter results that beat expectations. Let's get more from John McKenzie, CEO of TMX Group. John, thanks very much indeed for joining us. So just looking at your results in the latest quarter, what do you think jumped out? What was the most important thing?
Well, Andy, thank you for having me this morning. We're very excited about the quarter results and the year in general, because the overriding story here is the business delivered in every part of the franchise. So, the capital raising business really started to come back last year. Trading activity was up double digits across the board, and our global insights, data and information business was hitting new records. So this was not only a record quarter for TMX, it was a record year, both in top line growth and double-digit EPS performance. So across the board, we're thrilled with what we've been able to deliver. It allowed us to do a 9% increase in our dividend as well, relaunch our stock buyback. So I think it's something that the stakeholders around TMX can be very happy with.
Now, TD has a buy on your stock, but says there are AI concerns. And your biggest source of revenue in the latest period was global insights, aka market data. It does look as though investors are worried that that could be cannibalized by AI.
Yeah, I think, though, unfortunately, that the investors have got a misunderstanding of the nature of our business. And so let me clarify for you. You're absolutely right. About 41% of our business last year was in global insights, which is all of our information businesses. But unlike some other the software type companies that have been caught up in these challenges this week, our business is very much a proprietary business. And so our data and information is about proprietary data like TMX Data Links that has market data you can only get from us. Our Trayport business is our energy market, which aggregates on a proprietary network. Our Vetify business is about benchmarks and indices, which again are proprietary to us and embedded in products that investors use. So these are actually very difficult to disrupt with AI technologies. And the organization like us is obviously looking at AI technologies in terms of how do we actually get more competitive and more efficient in terms of how we bring these products to market. So on the Trayport piece I mentioned, we are already embedding AI capabilities in there to be more productive in how we bring the product to market. That's allow us to do more with the same resources year over year. So I do really think that this is a misunderstanding of the nature of our business. We're not a software sales business. We're a proprietary information business.
And then your second biggest source of revenue, well, capital formation equity was big at $82 million. Tell us, and then derivatives, of course, was the next biggest, 115 million. Tell us what derivatives you're big in these days, John.
Yeah, the derivatives business for us has been fantastic in 2025 and will continue to be strong in 26. It's very much a mixture of things that are retail-oriented, like ETF options. ETF options have had phenomenal growth, up 80% year over year. But we're also very strong in fixed income futures, which investors all around the world use to get exposure to Canadian dollar or to hedge those positions. And over the last number of years, we've been adding a lot more product to that. So things like 2-year bond futures, short-term, long-term, to ensure that whatever exposure an investor is looking for, they can get it on the Montreal Exchange. And that's allowed us to grow double-digit year over year. And the results we've had into Q4 this year has been, again, a record quarter in terms of use of those products by the industry. So it's a real kudos to the team here that have really engaged with the industry, understand what the product needs are, and put products on market that are going to help them with their investment experience and their objectives. So you're going to continue to see that strength in 2026.
Just maybe we can put up a 5-year chart for your stock, because it did hit record highs there last summer and then drifted down. And we've talked about the most recent sell-off, which is not unusual. I mean, not unique to you. London Stock Exchange shares fell this week. But why have the shares, would you say, broadly speaking, come down from August?
Yeah, and I never want to be really engaging in what happens on a short-term basis. We're always in this for the long term. I'm a big believer that we should be moving to semi-annual reporting as well, so that we have investors focus more on long term. But if you actually look at the results of the peer group, like all these exchanges and data companies that we're talking about today, over the last 3 years, TMX continues to be one of the strongest performers globally. And that's from not just a share price standpoint, but from a business results standpoint. You know, revenue growth, margins, EPS expansion. So we're not taking anything from this near-term downturn. We're focused on our long-term strategy. I believe it's going to play out in the long term, and the investors are going to come back to TMX as well.
Thanks very much, John. John McKenzie, CEO of TMX Group. It was interesting what he said about ETF options, and we should do more on that, on Know Your Options, which, of course, is every second Wednesday at 3 p.m. Eastern Time. Coming up, Amazon under pressure with its massive plans to spend on AI. Amazon plans to spend $200 million US. Now, not all of that is linked to AI, but a huge amount will be on data centers, chips, and other equipment. And that CapEx forecast $50 billion higher than analysts had expected. We have seen some pressure on Amazon stock today. Let's get more from Lloyd Walmsley, Managing Director and Senior Equity Research Analyst at Mizuho Americas. Lloyd, thanks very much indeed for joining us. What was your reaction? I mean, is there a risk Amazon is overdoing it here?
No, thank you for having me. Look, I think certainly there's a risk everybody's overdoing it here. Yeah. But I think coming out of this quarter, we got a lot of what we've been wanting to see out of Amazon for much of the last year. We saw a market acceleration in growth at AWS, a 4 percentage point acceleration, which was nicely better than we had been hoping for. And then the backlog growth accelerated by 16 percentage points. So they are clearly in a better position for cloud related to AI than I think people were giving them credit for just a few months ago. So we feel like they are investing a lot. I mean, these numbers are eye-popping across the board, but we are seeing good signs that there is early ROI. I think it's not where it's historically been, but we think over time it can get there, and so it's a worthy investment for them to be making.
So you say that AWS is catching up in AI cloud. Have they, to some extent, fallen behind their big rivals?
Yeah, I think they had fallen behind. I mean, they were slow to get going on, whether that's building LLMs themselves, whether that's building out the infrastructure. So I think they were behind for a bit. They may well still be, a little bit behind some of their peers. I mean, Google has been building their own custom AI ASIC chip for 10 years now, versus, AWS just the last few years on their Trainium chip. So, they're behind, but making quick progress is what it looks like to us.
Because one number you highlight, AWS backlog growth of 44 billion, in Q4 really lagged Google's backlog growth north of 80 billion.
It did. And I mean, the print we saw out of Google was extraordinary.
Yes.
Their acceleration in cloud, as well as margin improvement, was stunning. And I think Google isn't really disclosing exactly what's going on, but I think they're benefiting from the move to outright sell their TPU chip. We don't know exactly how they're doing RevRec, but clearly what they've got in that chip is something special in terms of the cost performance of that chip and its competitive positioning. And so they're really taking advantage of that and benefiting from that. And AWS, they have an incredible semiconductor team there. They've had enormous success historically with their Graviton chip. But again, the Trainium chip is, they're just rolling out their third generation. Google's in something like their 10th generation of TPU chip. So they are, they're taking advantage of that.
And they are, of course, they have so many strings to their bow. They are making lots of money from advertising as well through their retail platform.
That's right. I mean, advertising is one of the biggest beneficiaries of AI, and we see that across the space. I mean, Meta is an incredible example of that, with just a massive acceleration across both user engagement and the performance of ads. And Google is benefiting from that too. I don't think they benefit quite as much from Meta, just given the search business has historically been such a good business from an ad performance standpoint. There's not as much room to leverage AI, but on YouTube, they benefit tremendously. And so that is helping their core business. So yeah, Google's unique in that they're really benefiting on the application side with advertising, the infrastructure side with TPUs, and then they've got so much proprietary data to inform their models that they are really in a uniquely good position vis-a-vis AI.
Lloyd, thank you very much indeed for joining us. Lloyd Walmsley, Managing Director and Senior Equity Research Analyst at Mizuho, and the rating on that stock outperform with a price target of $315 US. Coming up, there are concerns that some software producers will be made redundant by AI, but our guest sees opportunities in the sector. That's ahead. Welcome to the second hour of The Open. Let's check out the big stories we're bringing you from our newsroom. Canada's economy lost nearly 25,000 jobs in January. Economists had been expecting a gain of 5,000. According to StatsCan, the country's manufacturing sector was hit the hardest, with U.S. tariffs continuing to weigh on industry. January's job loss marked the steepest decline since August of last year. The unemployment rate did drop to 6.5%, but that was mostly because fewer people were looking for work. Shares in Stellantis down 25% after the automaker says it is taking a write-down of more than $25 billion linked to its shift in EV strategy. Stellantis is selling its stake in a battery manufacturing plant in Ontario to LG Energy Solution. That plant was established in 2022, and LG will now be the 100% owner. Stellantis will continue to obtain battery products from the plant. Canadian packaged food company AGT Food and Ingredients, a specialist in pulse crops, for example, is looking to return to the Toronto Stock Exchange. The company is working on an IPO valued at $460 million and plans to price the new shares between $26 and $30. AGT was previously listed on the TSX before being taken private in a 2019 deal that included Fairfax Financial. And the TSX are rallying a little bit today, up around 1%. It hasn't been a great week for the markets. The big traders right now in Toronto in dollar value terms. Enbridge, big dollar value there, stock fairly flat. Celestica jumping $20 amid a rally in some of those tech stocks south of the border. And we've seen a whole bunch of companies that will make money from the data center build-out rallying today. GE, Vernova with its generator and electrical business, and the uranium stocks because people think we're going to need a whole bunch of new nuke plants for this extra electricity. We're also seeing the big golds, Barrick and Kinross up around 3%. And let's have a look at the US markets. They are ahead despite that decline on Amazon, the decline in Amazon amid fears that the company is overdoing it in terms of AI spend. Amazon stock down around 8%, but Nvidia's up around 5%, Micron up around 1%, and Tesla ahead almost 3%. So broadly, those giant tech stocks in the States up, although Alphabet is down. It too plans massive spending to dominate in AI. And let's have a look at Bitcoin, because of course that's in the news right now. Earlier, the price threatened to drop below $60,000 US for the first time since 2024, but we've seen a rebound from the bottom. I mean, it's had a hammering lately in tandem with a revival in some of those US tech stocks. Let's get more on these fears for the software industry. They were sparked by Anthropic, the AI player, coming in with a so-called plugin for its Claude co-working AI agent. There's a fear here that it'll help people to more easily use this vibe coding, as they call it, using AI to write code without the need for professionals, or certainly cutting back on the need for actual software companies. Our guest is not buying this fear. He says that actually software providers are well positioned to start delivering more valuable tools. We're joined by Kevin Burkett, president of Burkett Asset Management. Great to see you.
Good to see you too, Andy.
So you see an opportunity here in some of these software stocks that have sold off?
I think so. We looked at yesterday Amazon's results, so aftermarket close, pretty strong reaction to what was actually not a bad financial result. Sales came in slightly ahead, EPS a small miss. It was really a $200 billion CapEx spend that I think spooked the market a little bit. And looking for clues to how the market had calibrated their expectations around Amazon, you put that up against Meta, Google, $165 billion commitment, $200 billion from Amazon in that context seems large. But when you think about Amazon, and you've probably heard of this company before, employs 1.5 million people, $2.5 trillion stock, not as shocking to us. I think when we think about AI, though, coming to your software question, we see investors trying to predict AI, taking predictive positions and hyper-focusing on the physical infrastructure of AI, being Amazon's announcement about what will surely be streamed to the AI Amazon Web's AWS service. And where we're spending a lot of time is thinking about what we consider phase 2 of the AI build-out, which is in software. And I'm speaking more so to Tuesday's move in some of the enterprise software providers, Thomson Reuters, London Stock Exchange Group, data businesses. And so if you change your disposition and how you angle to the AI theme from trying to predict short-term results, hyper-focusing on the physical AI infrastructure, the chip makers, this being NVIDIA, Taiwan Semi, suppliers to chip makers, ASML, and come to start to think about how those tools that may be under capacity constraints, but I think more interestingly, get extended into business applications. I think we see opportunities in businesses like Constellation. I think Thomson's Thomson Reuters' move is an opportunity. When you think about a role that software developers will play in facilitating some of that extension from the very interesting kind of mostly chatbots happening in clouds that require this physical footprint into business applications, and then we think about phase 3 being how across sectors and even within sectors, businesses then apply those tools to their own use cases. So what we speak about when it comes to software is whether the market is right in thinking that potentially that second phase could be skipped. Because that is why you see Thomson Reuters down, you see Wolters Kluwer, the software providers, reacting so negatively, is there's a sense that with tools like the tool you mentioned about the Anthropic tool that Cloud released, whether companies can kind of self-adopt and implement those tools.
And that could be tricky, in something like payroll or, the actual hard applications where you got to get it right.
Exactly. I think, there's a notion that, Larry in accounting with his Claude subscription is going to build, some of these mission critical tools and that you can unplug from SAP. I'm not sure that's true. I mean, I own a business. I think there's lots of interesting applications around edge cases. I think much of the software that's sold to us is overbuilt by the software developers. So I think this gets better for everyone, but I think actually it's an enabler for the AI software folks who are willing to adapt to some of these AI tools in the software applications themselves.
So in particular, Constellation Software, it was just a touchstone for a blue chip stock in Canada for so long. Maybe we can put up a 10-year chart. Would you be a buyer now of Constellation with new money?
Absolutely. I think, the Canada's a funny market when you think about AI. I mean, we've got Celestica, which is kind of interesting, but we mostly have these software businesses. And you look at OpenText that put results out yesterday, that's a very complicated story. So you think about OpenText, CGI, Constellation, how do you approach your tech portfolio here in Canada? Constellation, and I mean, I've been started this firm 10 years ago. It's one of those stocks that you watch and you want to buy it, and then it looks expensive, and then it gets more expensive. I think this is a rare opportunity for entry. September, Constellation CEO, who's somewhat of a prolific guy, Mark Leonard, surprised the markets. It was a health-related resignation as CEO. So that was kind of the first opportunity. I think some of the overhang on AI adoption is the second. And so you look at Constellation as being very central to this theme that I described, which is software fundamentally shifts over the coming years from systems of record to systems of action. And I think that makes software more valuable. And so I think if you're a Constellation aggregator type business where you're buying software that's already embedded, I think you're well placed to facilitate a transition into a more powerful tool set for your customers. And I think putting a more valuable set in your customers' hands, I think you can charge more for that. I think there's absolutely a role to play. And I think, as I say, these mission-critical business systems, which is really the bread and butter of businesses that Constellation looks for in their business model, which is mostly about acquiring companies that have those features. I think it's a great way to play that theme in this so-called phase 2 that we see as the next second-order consequence of AI.
We have another idea here, Pollard Banknote. Haven't talked about them for a long time. And of course, they're big in lottery tickets, both physical and online lotteries.
Sure. So stepping back from AI, which is the hyper-focus, and so whether you're trying to predict what the next new thing in AI is and prepare for it, what's interesting is we see the focus on AI and tech spilling into Canada, and so there are a lot of overlooked businesses that are more value-style businesses where I think if you're approaching your portfolio, if you're finding it, a complicated setup moving into 2026. You've had a good year in the Canadian stock market. You're coming off of a 32% return in 2025, but you're seeing that 11% of that was driven in precious metals, so you're nervous. I think that if you're nervous, so am I. I think that our approach to this comes in two ways. One, I think you've got to be aware of what's happening in some of these big themes. But I think second, there are businesses, and Pollard is one, where you can step away from all that noise and find overlooked opportunities. And to me, Pollard is a great example You look at CUSMA, USMCA. I was in Ottawa on Wednesday. I saw Stephen Harper's speech. I think investors can take note of a dispassionate approach to some of the trade tariff discussions. Pollard is selling scratch and win lottery tickets. The business is recession resilient, let's call it. Demand for lottery tickets tends to be fairly stable. Highly regulated space. Good company.
Why has the stock drifted, though, for quite a few years now?
The company itself, I think, is trying to find direction. It's owned mostly by the family, so 2/3 of the shares are in family members' hands. And when you look at the company, they've improved margins. Revenues very steadily increased over decades. But I think the question or the overhang on this stock is what does the future look like for Pollard Banknote? And I think while we wait, I think making bets today is I think future catalysts around what the future for this business holds could be more interesting. But in the meantime, it's a great earnings compounder that gets you out of the day-to-day swings of whatever the latest and greatest AI thing is.
Thanks very much indeed, Kevin.
Thanks.
Our guest has been Kevin Burkett of Burkett Asset Management. Up next, the grey wave is about to redraw the map for investors. When we come back, we'll look for a few ways to profit from an aging society. World's population is getting older, and for some market pros, this is creating an investment opportunity. BNN Bloomberg contributor John Ehrlichman has a new story on our website on that theme. John hosts Ticker Take on YouTube, and he joins us now. John, tell us about this grey wave.
Well, the stats are undeniable, Andy. I mean, we talk about it in general terms a lot, but when you dig in, I know a lot of people these days are thinking about growth from AI. Growth from an aging population is a reality. The World Health Organization notes that within 5 years, 1 in 6 people on the planet will be 60 or older. What's the growth story of those who are 60 or older? Well, it will have the population globally, that is, gone from around 12% over 60 back in 2015 all the way up to around 22% of the population by 2050. And speaking of 2050, if you look at even older ages, 80 or older, that population set will have grown triple essentially from 2020 to 2050. So when you start talking about demographics, regardless of the reasons, you start thinking about the different businesses that cater to an older society. And that's what Neela White has been doing. She's a longtime BNN Bloomberg guest. We spoke to her on Ticker Take, and yeah, that story's on the website. And she went through 8 different companies that sort of feed into that trend. But it is a massive trend globally right now, and it's hard to ignore.
Tell us about some of the stocks that Neela White is zeroing in on.
So when it comes to caring for those, particularly, let's say 80 or over, it's obviously, the story of finding the right residences to live in, the communities. Obviously, families are always dealing with that, or they're dealing with long-term care. So some of the companies that Neela has in her portfolio are names that come up a lot on BNN Bloomberg, whether it's a Sienna Senior Living or a Chartwell or an Extendicare. You have Welltower in the United States that came up to Canada, did a big deal for Amica. I mean, there are companies that are spending a lot to build up their assets in this area. So those would be some examples. But also, Andy, when you think about retrofitting your home, what if you're going to stay in your home for longer? Companies like Severia, whose executives have been on BNN before, where you can, make easier access upstairs in your house. Another example might be K-Bro, which is in the linens business, and that has been a growth business too, Andy, at hospitals. So those are a few examples for Neela's portfolio.
And I guess also senior housing complexes, K-Bro, huge in linens. John, we'd better jump. Great to hear from you as ever.
See you.
And John, you can find his story on our website, bnnbloomberg.ca, and on the Ticker Take YouTube channel. That was John Ehrlichman. Okay, we have lots more coming up on the Open. We're going to talk about Thailand's economic engine. It has sputtered. Exports are down, investment fading. What went wrong? Thailand's economic rise was once seen as unstoppable, but decades of political strife, inequality, and stalled growth have turned it into the cautionary tale of Southeast Asia. Bloomberg Originals takes a closer look in this week's Short Doc.
When I think of Thailand, I think of a place where modernity exists alongside tradition. But behind that postcard image of a paradise is another reality. Instability, volatility, uncertainty.
And in recent years, economic lethargy.
There's not a lot of innovation in the economy. Thailand's GDP growth has been about 2% for a while now, while neighboring countries or peer economies are growing rapidly.
Foreign investors have taken note, or more specifically, they've taken their money.
Thailand looking to cut rates as growth falters.
No catalyst for a reversal of Thailand's fortunes.
That word, fortunes, isn't relatable to almost anyone outside Thailand's entrenched elite. According to the World Bank, Thailand has the highest level of income inequality among Asia-Pacific countries.
What's at stake is Thailand risks getting left behind in one of the world's fastest growing regions.
So we're asking, what went wrong? And can anything be done to turn things around?
Welcome to the White Lotus in Thailand.
HBO's The White Lotus offered a high-profile glimpse of the experiences that make Thailand a draw for travelers.
Tourism accounts for about a fifth of its economy. Thailand is quite reliant on tourism, more so than its peers in the region.
Like those peers, the country's also a hub for manufacturing across multiple sectors.
Automobiles, agricultural products, food, and electronics. And it connects supply chain between China and the rest of Southeast Asia.
Those two economic engines, tourism and exports, drove Thailand's $570 billion economy in 2025, ranking it third in Southeast Asia. But those same engines are showing signs of strain. And the White Lotus, sadly, did not include a single chart about this.
Before COVID, Thailand was on track to reach 40 million foreign visitors a year. Then COVID hit, and tourism arrivals have never really gotten back to the numbers that we've seen before.
On the manufacturing side, geopolitics has also been a drag.
In 2025, the U.S. government imposing a raft of tariffs around the world, so this is upending trade, this is upending investment.
That's what you're seeing here, a measure of money flowing in and out of Thailand. Since 2023, investors have been mostly pulling money away, and by late 2025, the outflow reached a record high. Here's the thing, though. COVID and tariffs affected everyone. To understand what's uniquely throttling Thailand's growth in an otherwise flourishing region, we have to look back even further.
Thailand saw rapid growth and industrialization in the 1960s, and it transformed from an agrarian, low-income country to a manufacturing powerhouse. The 1990s was the golden era of the Thai economy.
Thailand was on track to escape poverty and become a rich country. The economy was expanding at such a rapid pace, 8% to 9% a year. People were spending, banks were lending, companies were hiring.
But financial institutions took on excessive risks, bad loans, and a great current account deficit.
And then, in 1997,
when the Asian financial crisis hit, speculators started attacking the baht, and the currency lost more than half of its value.
Banks failed, businesses went bankrupt almost overnight, millions lost jobs.
In the early 90s, Thailand's gross domestic product was growing at a healthy clip, around here. But the financial crisis left a deep scar, and growth has never returned to the same level. So why not?
In the wake of the 1997 financial crisis, Thailand elected Thaksin Shinawatra as its prime minister.
Thaksin's political rise is inseparable from his business success. As the founder of Thailand's largest mobile operator, he gained the wealth, visibility, and public profile that helped him connect with voters.
He became the country's most popular and also most polarizing politician in decades. Growth of the Thai economy picked up under Thaksin's administration.
But economic and political success made Thaksin powerful in the eyes of Thailand's old guard.
The establishment that's made up of senior bureaucrats, business elites, judges has controlled the country's most powerful institutions since the country became a constitutional monarchy in 1932. They did not want a strong elected government that would clash with its interests.
And that came to a boiling point in 2006.
Thaksin was toppled in a military coup that has led to a decades-long rivalry between Thaksin and the old guards.
Years of protests and leadership changes followed. And this consistent political upheaval is the first major contributor to Thailand's unique economic problem. Thailand has raced through prime ministers over the last 20 years. 5 of them from Thaksin's camp, who came to power through elections, have been ousted by court or by coup.
This is a tug of war between the establishment and the civilian government. They take turn governing the country, but at the same time, none of them stay long enough to really introduce any meaningful changes.
For decades, this has broadly been defined by a power struggle between pro-democracy advocates and the elite.
Since Thailand became a democracy, it already had 13 successful coups and about 20 versions of the constitution.
From an investor point of view, they want to have some certainty that the policies that are in place today will be surviving over the course of an investment. But when you have a revolving door of governments, you don't have that certainty.
Thailand's concentration of wealth at the top has created another unique bottleneck for the country.
One of the world's highest income inequalities.
In fact, its richest 10% controls nearly 70% of the nation's wealth. That's higher than any other country in the region, such as Indonesia, Malaysia, and Vietnam.
Bangkok and other economic corridors were booming while the rest of the country was engaged in low productivity agricultural practices.
The majority of corporate wealth in Thailand are in the hands of just a few hundred people. Rich billionaire family in Thailand control large conglomerates that dominate key sectors across the economy.
In Thailand, political access protects business interests while wealth gives you more political bargaining power. Often, when economic power and political authority sit within a small group of people, they resist changes to reduce monopoly, increase competitions, and redistribute wealth.
And increasingly, this is being passed on to ordinary families, already burdened by long-standing debt.
This is a legacy of the post-1997 crisis where credit was used to revive growth. But when wages stagnate and consumption is expected to rise, households borrow, and sometimes more than they can pay back.
At roughly 90% of GDP, Thai household debt is now among the highest in Asia, only scarcely below South Korea and Hong Kong. Now, when a huge chunk of a family's income goes toward interest payments, it's harder for them to spend on anything else, and that includes further education, bringing us neatly to the last stop on our tour of Thailand's unique economic bottlenecks: talent.
Thailand produces relatively fewer engineers, data scientists, and those high-skilled jobs than the rest of the Southeast Asian countries, and it also doesn't have the same level of English proficiency as other countries either.
This is holding Thailand back, while countries in Southeast Asia are racing to attract AI and semiconductor investment.
Thailand is sort of stuck in old technologies that is slowly losing momentum without having any new products to offer to sell the world.
And it's facing another issue with its workforce.
Thailand is aging faster than it is getting richer.
So About the middle of the 2010s, Thailand's working age population, the growth in that cohort started to slow dramatically. And then from about 2019, actually the workforce started to shrink.
And looking ahead, this decline is projected to keep accelerating for decades to come. If nothing changes by the 2030s and 2040s, the workforce could contract by around 1% each year. So today, Thailand is battling a perfect storm: stagnant growth, soaring debt, and a shrinking workforce, all against a backdrop of political instability and deep inequality. Its leaders are faced with solving a puzzle of debt and demographics in a world that won't wait for it to catch up. Policymakers say they're aware of the most urgent issues.
We have planned on upgrading productivity in Thailand, especially reskill and upskill of Thai people, promoting investment.
Yet, no matter who's in power, they'll have to contend with the same problem that's held the country back for decades.
There's not a lot of focus in building industries that could power the economy into the future. Political instability is a root cause for that, and unless there's a meaningful reform in the political system, in the power structure, Thailand is never really going anywhere.
Fascinating stuff. Thailand, that was seen as a poster child for economic growth in Southeast Asia, falling behind. We got to take a break. The Open will be right back. The economy lost nearly 25,000 jobs in January. Economists had been expecting a gain of 5,000. According to StatsCan, manufacturing was hit hardest, with U.S. tariffs continuing to weigh on industry. January's job loss marks the steepest decline since August of last year. Meanwhile, the unemployment rate fell to 6.5%, but that was mainly because people dropped out of the labor force. We're watching shares in Canopy growth today. Earlier, they showed signs of strength, now drifting down. The company posted net revenue and profit for its third quarter that beat expectations. In fact, revenue hit $74 million. Canopy says the results were driven by strength in the Canadian market as well as cost-cutting. However, international markets revenue dropped 31% year over year. Another look at shares in Amazon. They are down today after the e-commerce and cloud computing giant said it plans to spend $200 billion this year on things like AI data centers, chips, and other equipment. And that forecast is $50 billion higher than analysts had expected. Analysts are noting concerns about how much big tech companies are spending on AI-related investments, and some question when these will actually pay off. And there's a look at North American markets, and they are higher right now after a choppy week. You can see the TSX rallying about 1.5%. Just looking at the performance, though, over the past week, the S&P 500 still down about 1% in the past 5 days. NASDAQ down almost 3%. Toronto is ahead, though, up about 1.6%. Yesterday, the Prime Minister announced major changes in policies when it comes to the auto industry. It includes bringing back EV subsidies for consumers. We sat down with Flavio Volpe, president of the Automotive Parts Manufacturers Association, to discuss the benefit of swapping out a sales mandate, which would have forced the auto industry to sell a minimum number of zero-emission vehicles, for an emissions standard.
It shows that the government of Canada, and led by the Prime Minister, listens to the industry. That said plainly, the old system, the EV mandate, picked one specific technology at a moment that wasn't available to Canadians and wasn't available to Canadian manufacturers. and we said we're all committed to electrification. We have to have a ecosystem approach where we make it easier for Canadians to buy them. We make them more available. We invest in the infrastructure to charge them, and we bonus Canadian companies who are making lower carbon emitting vehicles and parts to benefit from this. I liked it. There was a risk here that we would end up in another system that said, look, let's just pick one technology and force everybody there. This allows everybody, including the companies that we're chasing in hydrogen and companies who make internal combustion but make more efficient ones, to have a path.
Okay, so let's dig into it a little bit more. What do you see as a benefit, if you do, of swapping out a sales mandate for an emission standard?
Well, look, the sales mandate said the only way to get to the point that we want is if you build electric vehicles and you build 60% of them by 2030 and 100% by 2035. And the only way to get there is if Canadians bought those cars. So it didn't do anything, though, to get the Canadians to buy those cars. But what it did was penalize producers for the lack of demand. Why were we going forward with an electric vehicle mandate? Well, we wanted to take carbon out of the tailpipe across the fleet of vehicles that are sold and manufactured in this country. So the Prime Minister said today, look, we're targeting outcomes, and that's carbon reduction to 72 grams per kilometer. And you can get there any way you want, but you have to get there. For Canadians who want electric vehicles, we're going to make it easier for you. We're going to give you a $5,000 rebate. And for those who want them, but for whatever circumstances or use case, only want to go plug-in hybrid at the moment, there's a brand new one. It's $2,500. And by the way, if you want them, and money isn't really the issue, but charging is the issue, the government is making this monumental investment of $1.5 billion into the charging infrastructure across this country. There's enough there for everybody, the consumer and the manufacturers, and for those manufacturers that we want to come here. There are no Canadian manufacturers of vehicles, just of parts. But, we're trying to chase companies like Hyundai to make the business case, and their hydrogen-powered vehicles did not make the grade in the former EV mandate.
Okay, so there is still a goal of having 75% of vehicle sales be EVs by 2035. So don't you think that just kicks the can down the road?
No, actually, it isn't a goal of 75% EV sales. What it is it's a reduction in carbon that would be the equivalent of 75% EV sales. What this is going to do is going to take those companies that right now, for their vehicles and those use cases, have V8s or six-cylinder engines, and say, you can get there to that carbon target with smaller, more efficient engines, or you can get there with plug-in hybrid, or you can get there with hydrogen fuel cell, or you do it in boiling warm water. However you want to get there, the carbon at the tailpipe is equivalent to 75% EVs, but we're not going to tell you they need to be EVs. They just have to reduce the carbon that we emit. And in the end, we don't have a climate crisis because we don't have EVs. We have a climate crisis writ large because there's too much carbon being emitted by industry, by consumers, by society. So this says you're going to have to do your part as automakers to reduce the carbon output. How you get there could be your choice, whatever recipe that you have. And you have to get there. If you don't, you can't certify those vehicles. So Canadians whose priority is making advances in climate and not necessarily making EVs should know that the government of Canada did not relent on the climate objectives here. It just said, hey, especially to the companies that are invested here, buying Canadian capital and equipment and employing Canadians, we're not going to bonus the Chinese who are way ahead on EVs here. If you can find your own way there, we'll co-invest with you, but you must get there.
Okay. You mentioned that we don't make EVs in Canada. We make parts, but we don't actually make the vehicles. What in the announcement today will bring some of that production or lure some of that production to Canada?
Well, to be clear, I'm saying there's no Canadian auto company that makes EVs, but there are companies in Canada making EVs and plug-in hybrids and conventional hybrids. That's anything from Stellantis down in Windsor to Toyota in Woodstock to Honda in Alliston. What this allows the companies to do is to say, look, you can offer an EV product and a plug-in hybrid or a hydrogen fuel cell. And some companies like Hyundai do all of them. Toyota does all of them. And it says, you don't have to just be in the business of making EVs and hoping that somebody buys them. You take your whole fleet of everything that you do, and we're going to reduce carbon by 57% by 2035. And however you get that mix there, know that product has to be sellable to Canadians. We'll help them buy them if they're EVs. But if you want to get there in another mix, you can. That allows those companies to take different risks on product designation. Why would they do it in Canada is the question you're getting at. In this country, we have the world's biggest supply of the critical minerals and the chemistries that go into the batteries of all of those vehicles. A battery in a Mustang Mach-E is about half the value of the vehicle. Right now, they're being manufactured in North America, but they don't have Canadian chemistry in them. Why? Because we haven't made the business case yet for our critical minerals. So the more flexibility that manufacturers have, the more flexibility they get in the windup. But together with the other things that this government has done on major projects, permitting and infrastructure support, we could start telling Ford Motor Company that you can get the lithium from Canada in 2030 at this quantity, at this price, at this location. This is just a much more mature approach and an ecosystem approach to the same problem, but one that's realistic for companies that are already invested in Canada, that are buying Canadian parts and employing Canadian workers. And that's really important given what we're facing at the White House.
Next up, Hot Picks. We're going to zero in on 3 plays in commodities. We'll be right back. Time for Hot Picks, and there's a common theme. All 3 companies are involved in potash, the fertilizer. Our guest star pick is K&S, a German potash producer with assets in Canada and Western Europe. We're joined by Taylor McKenna, analyst at Copernic Global Investors. Taylor, thank you very much indeed for joining us.
Thank you, Andrew, for having me today.
Start off with K+S, please. Why should investors, do you think, take a look at this one?
Sure. As I get into it, let's take just a quick step back first and talk about potash. So potash is a key input into the global farming, and we need it to have the food that we eat on a daily basis. And we like to buy these things when they're below incentive price. And currently, potash is well below incentive price. So we have incentive price north of $500, and with potash at around $350 today, we see incredible upside in companies like K+S and even Nutrien. So K+S is in the mid part of the cost curve. So they're about break even today. And any uplift in potash prices as they move towards incentive price give the company a lot of operating leverage and great optionality. They have incredibly long mine lives. And of course, as these things move towards incentive price over time, we expect it to do quite well. As I get into my second pick, Nutrien, which is from Canada, right in your backyard, they're the global leader in potash. They have the best assets in the industry, and while they have a little less upside than K+S, we also really like that company as well.
And can we just loop back to K+S? So they opened the Bethune mine near Moose Jaw, Saskatchewan, and they say it's a solution potash mine. Does that change the economics of producing the mineral?
It doesn't change the economics that much. By solution mine, they're essentially pulling brine or water out of the ground and then extracting the potash from that, as opposed to pulling out dirt. It can be lower cost at times, and it is that mine in particular for K+S is on the low part of the cost curve, and it's performed very well recently. They're also going to increase production slightly there over the next few years.
Looping back to Nutrien, of course, they're very diversified. Potash is a major part of their business, but are there any other reasons why you'd be attracted to NTR?
Well, potash is the main reason. They have the best assets in the industry. They also have a very good nitrogen business, but they've talked about spinning that out or selling that. So that is a far less part of our value within Nutrien. But the other thing I think that's important is they have a global distribution network where they can sell all of these things across the world, actually, but particularly in North America and South America. So they have some assets that are not replaceable, but again, potash is the key one.
And then finally, BHP. And of course, they are ramping up in potash with their gigantic mine in Saskatchewan. It has been hit with huge cost overruns. And of course, potash, it's a major investment for them, but they're in other minerals in a big way.
They are, and I think here we're value investors. So we take what the market gives us. We've, for a long time, been very heavy in precious metals, particularly gold and platinum. We still like them from a fundamental perspective, but so does the market. And we've harvested some gains there and moved into these large diversified miners, including BHP, which is really the largest copper producer in the world, has a great endowment around the world. You mentioned potash, which they also have. They also have great iron ore assets and really a hidden gem in Olympic Dam, which is a polymetallic deposit. So we really like BHP at these levels, but we would also include Vale, which is the largest iron ore producer and has the best mines, and also Glencore, which of course has been in the news a lot recently.
We've only about 30 seconds. Could I just loop back to a term you used there, incentive price? What do you mean by that in the context of a potash producer?
Sure. Great question. So what we mean is, what price does the market need, or do companies need to build a new large mine, right? And actually, Nutrien discloses this in their presentations. They think that price is north of $500. So absent $500 or above, you won't see any new large mine built. We like buying these things in those situations because supply is almost capped and demand continues to grow.
And where is the price now, roughly, of potash?
Around 350.
Oh, wow. So according to Nutrien, anyway, we're a long way from encouraging new capacity. Thank you very much indeed, Taylor. Really appreciate it.
Thank you so much for having me.
Taylor McKenna, analyst at Copernic Global Investors. Up next, one last check on the markets. Let's check in on the markets before we go. And let's focus on the 1 week performance of some big indices and stocks. There's the TSX. So still ahead, although it was choppy, especially with the selling in software names this week amid AI disruption fears. Let's see how gold did. Gold, of course, has been blasting to records and then dropping. You can see gold down about 2%. This week, but still at almost $5,000. It's super lucrative to be producing that metal right now. Let's see how Bitcoin did this week. Earlier, as I mentioned, it threatened to drop below $60,000. It has rallied today, but still down. Wow, look at that, down 18% in the past week. Let's check out how the NASDAQ has done. Of course, when a huge stock like Amazon struggles, it's going to weigh on the index. Now, the NASDAQ is up today, but down 3.5% this week. Let's have a look at Bank of Nova Scotia because it's finally hitting a record high. But that stock languished after moves under the previous CEO, disappointed in investors. But that stock finally getting up to a record high. And finally, let's have a look at Loblaws. Good old reliable Loblaws, as far as a lot of investors are concerned. That stock hitting a record high today. And we all have to eat. Yep. New record high for Loblaw today. Thanks very much indeed for watching The Open. Morning Markets is up next.